How much money do I need to start investing in the stock market? Introduction. Many believe that investing in the stock market is only for millionaires. The truth is that this is a myth that limits thousands of people. We live in a time where access to financial markets is broader, simpler, and more affordable than ever. However, the doubt remains. How much money do I really need to start investing in the stock market? The short answer is less than you think. But the long answer involves financial preparation, mindset, and strategy. This article will walk you step by step through a realistic and actionable process to start investing in the stock market from scratch, whether you have $100 or $1,000. Get ready to break myths, understand market realities, and take the first step toward your financial freedom. Why is investing urgent in 2 to 5? Inflation is eroding the value of your money every day. Stashing cash under the mattress or in a low-yield savings account means losing purchasing power over time. In the past, saving was enough to build stability. Today, it's merely the first step. Salaries are stagnant in many countries, the cost of living is rising, and pensions are in crisis. If you rely solely on active income, you're in a vulnerable position. Investing allows you to build passive income, multiply your capital, and protect yourself against economic crises. The traditional system never taught you to invest, which is why so many people reach old age without a financial plan, alternative income, or time and money freedom. The good news is that today you can break that cycle. You don't need an inheritance or a stroke of luck. You need information and action. How much you need and how to start. Change the question. Instead of asking yourself how much money do I need to invest, ask how much am I willing to learn and commit each month. Investing in the stock market is not a one-time act, it's a habit. You can start with $5, $20, or $100. What matters is consistency and discipline. Even a monthly investment of $25 can grow to over $10,000 in 20 years if kept consistent and reinvested. Build your financial foundation. Before investing, make sure you have 3 pillars, an emergency fund of at least 3 months of expenses. For example, if you spend $1,000 per month, you should have at least $3,000 in a separate and safe account. No high-interest debt, such as credit cards with rates over 30%. A stable or predictable income, so you're not investing money you might soon need. Having these basics covered reduces the risk of having to sell your investments when prices are low. Understand what you can do with little money. With less than $100 you can already buy fractional shares of major companies like Apple or Amazon. For example, many platforms let you buy a fraction of a share for just $5. Invest in ETFs that replicate the performance of the whole market, like the S&P 500 or the Nasdaq. Use micro-investing apps like Acorns or Stash that round up your purchases and invest the spare change automatically. Nowadays, many platforms allow you to start with symbolic amounts, but the growth potential is real, because what you do consistently compounds. Choose a reliable platform. Look for a broker or app that has low transaction costs, ideally under 1% or even 0 commission, access to stocks, ETFs, or index funds, good customer support and built-in educational resources, regulation in your country or internationally. Examples: Interactive Brokers for global investors, GBM Plus for Mexico, eToro for social investing, or Trading 212 for Europe. Always check if they are regulated by authorities like the SEC or CNVRV. Start with low-cost ETFs. An ETF is a fund that groups many companies. By investing in it, you're diversifying from day one. This reduces risk and supports long-term growth. Example: with $50 you can invest in an ETF like VU or SPY, which represent the 500 largest companies in the US. This is better than buying a single stock and protects you from the volatility of one company. Automate your monthly investments. The key is not the amount, but the consistency. Invest $25 every month for 10 years and you could build a portfolio worth thousands, thanks to compound interest. Set up automatic contributions, ideally on the same day you get paid. This turns investing into a subconscious habit, like paying your electricity or water bill. For example, you can automate a transfer to your investment account every 2 weeks or monthly. Reinvest and be patient. Reinvest all dividends you receive, don't spend them. Let them add to your capital. Over time, interest on interest will create a multiplier effect. Example: if you invest in an ETF that pays quarterly dividends, Reinvesting those payments can add 1% to 3% extra per year in returns. The stock market is not about getting rich quickly, it's about being patient and consistent. Money grows over the years, not by luck. Learn about risk and diversification. Don't put all your money into a single stock or cryptocurrency. Mix different sectors, countries, and asset types. A good rule is to hold 3 to 5 different types of assets. Example, 60% in global ETFs, 20% in bonds, 10% in digital real estate, 10% in cash or crypto. Diversification protects you during downturns and gives you peace of mind. If one part of your portfolio drops, another may rise. Keep learning, read books, listen to podcasts, watch videos, take courses. Investing isn't something you do once and forget, it's a lifelong skill. Recommendations: book, The Intelligent Investor by Benjamin Graham. Podcast, The Investors Podcast. YouTube, channels like Value School, Balio, or Minority Mindset. The more you know, the better you decide. The better you decide, the fewer mistakes you make. And the fewer mistakes, the more money you keep and grow. Change your identity. Stop thinking like a saver. Start thinking like an investor. A saver stores money. An investor multiplies it. A saver fears risk. An investor manages it. It doesn't matter if you start with 10, what matters is that you act like someone who builds wealth, not someone who waits for it. The real change isn't in your wallet, it's in your mindset. Conclusion: the real question isn't how much money you need to start investing. The question is when you'll decide to do it. The answer should be today, even if you only have $5. What matters is taking the first step, breaking the inertia, and building the habit that will transform your financial life. It's not about getting rich fast, it's about becoming someone who takes control of their money, who learns, grows, and builds a future. The market doesn't wait, neither does time. But you can choose to start today. If this content gave you clarity and motivation, subscribe to keep learning every week. Like this. If you now know you don't need to be rich to start investing, comment how much you plan to invest this month, or which asset you'd like to start with. And share this article with someone who needs to understand that starting is easier than it seems. Investing is for the brave, and the first act of bravery is to get informed and take action. Today could be the day that changes your future.